name's Martin Luke, and I'm here to talk to you today about financial spread betting. Tom originally asked me to come and talk about shorting stocks and shares, and then he changed it to financial spread betting. So I had already written my bit on shorting stocks and shares, so this is going to be very weighted towards that, so I apologise for that. I've worked in the stockbroking industry for about, over 20 years. I worked for a small hedge fund initially before I worked and then I went on to work as a prop trader and helped set market making within a bank, and then I moved over to private client stockbroking. So my skill set's very much been involved in stockbroking. Tom's described me as being a spread betting maestro, which isn't quite correct, but I sort of obviously by default know the industry quite well. Obviously, is a given, anything I say today is not advice or anything, but we're not going to talk about stocks and shares anyway. So what is financial spread betting? Before I start, can I just get an indication of the sort of level of knowledge? Have any of you got spread betting accounts? Of all of you? Is anybody who's never spread betted? Okay, so there's 3 or 4. Okay, cool. So spread betting is a way of gambling, speculating, putting a wager on the movement of an underlying stock, commodity, index, an FX pair or something like that. It's very important, I believe, to understand that spread betting is not investing, it is gambling, and you should only use money that you can afford to lose. It is very high risk, and because it's a margin product, which we'll come on to in a minute, you can lose more than you initially put in. So the advantages of spread betting is that there's no stamp duty or commission payable. I've put an asterisk there on commission because what they tend to do is on the spread or the price, you will pay a higher price than you normally would, and that's where they put the commission. They blend it into that. So if a spread betting firm were to say to you, we don't charge any commission, it's because they hide, as you all know, nothing's for free. They hide the cost into the price itself. Because you're gambling or betting, there's gains are subject to no capital gains tax. And because of the very nature, if you're trading in stocks, it's relatively cheap. But if you were to start trading in futures, options, commodities, FX can be quite cheap. But the actual back office settlement system can be quite expensive. So that's why it's quite prohibitive if you're going to go through a normal stockbroker if you want to deal in these instruments. So because spread betting, there's not that functionality behind it, it becomes a lot easier because they're not, you're not actually buying the underlying or selling the underlying. So it becomes a lot cheaper, and they have a much greater range of markets available to them. The other advantage is it's a margin product. So I'll focus today predominantly on equities. If you wanted to buy £100,000 worth of Vodafone, let's say, which is a FTSE company, that would typically be margined at 10%. So to buy £100,000 worth, you don't need to put up £10,000. The big advantage then, if Vodafone was to move 10%, you would have actually doubled your money. It would have moved to 110, so your money would have doubled. You can also limit your risk by using stop losses, which I would advise anybody, certainly when you're starting off, to use those. You have the ability to go long or short. By long, I mean buying the stock, and by short, I mean selling the stock which you don't own in the belief that it's going lower. You also have the ability to place very small bets, and this is a really good feature about spread betting, especially if you're inexperienced and you're just starting, because you can actually, for a relatively small amount of money, you can start trading and betting, and you can sort of bet 50 pence a point or £1 a point on movements of indexes and things like that. There's an old saying that if you think education is expensive, try ignorance. And I've seen many people sort of lose quite considerable sums of money thinking they know what they're doing in the market, especially when they're trying to trade. So if you are going to start off, or you plan on starting off, and you're going to deposit whatever, maybe £5,000-10,000, I would strongly recommend that you start off very, very small baby steps. In my experience, I've seen many people start trading the market and they'll have a few wins, and the more wins, and they'll say, oh, I wish I'd bought 10,000 instead of 1,000 shares, I'd have been that much more. And it's almost guaranteed, as soon as they start getting bigger and bigger and bigger, that's when they'll lose all their money. And dividends are paid immediately. So if you are trading a stock that pays a dividend, FTSE stock or something like that, instead of having to wait for the X date, you will get paid that up front. The disadvantages. We mentioned earlier, you don't have to pay capital gains tax. Disadvantage then is, if you do lose all your money, you can't put it against tax, obviously. Another disadvantage is that it's a margin product. I earlier said that was an advantage. It's an advantage if you're winning. If you're losing, it's a massive disadvantage. Because in my earlier example about Vodafone, if it was to move up 10%, if it moves down 10%, you've been completely wiped out. Unlimited losses. So if you were short of something and it starts to run away from you and you haven't got a stop loss in place, then your losses can go on and on and on. Wider spreads. So the price, the difference between the bid and the offer, that's your spread. And because they blend funding and costs into that spread, then the spread can be wider. Credit offered. Maybe some people may think that being offered credit is an advantage. Personally, I don't, because it just encourages people to use money they haven't got and to lose money. Again, markets can be very volatile, and with spread betting, because it's a margin product, if you actually own the stock, you can go to sleep at night, not to worry too much. But when it's a margin product and if the market's volatile, you can have sleepless nights sometimes worrying about what's going to happen in the morning. Because you don't actually own the stock, also, you don't have any voting rights or anything like that. If you had a very large position in a stock and you asked the spread better, could you have your voting rights, they can allow you to do that, but they don't have to at all. And again, it's not really suitable for long-term investors. Products available. As I was explaining earlier, because the complexity of having a back office is removed, then the products available to you to trade, which wouldn't normally be available to sort of retail especially, are far bigger. So you can trade stock market indices. By indices, I mean the FTSE 100 or Dow Jones, the S&P, the DAX, the CAC 40. These are by far the most popular, certainly with beginning or new investors. Then, of course, you go on to individual shares, currency pairs, commodities. I put interest rates, futures and options and bonds at the bottom. Certainly when it comes to interest rates and futures and bonds, futures and options, for example, is a margin product in the first place. So it's almost suicidal to start trading these because you're doing margin on a margin product. So it really can damage you. So I would strongly recommend that nobody trades futures, options, bonds or interest rates on a spread bet. So how does it work? A spread bet, as we were saying earlier, is effectively a wager. You're betting on the future movement of an underlying instrument. That underlying instrument, as we say, could be an index, a stock, or an FX. And if you believe the underlying product is going to rise, then you buy it in the hope of the profit from the move. And likewise, in reverse, if you think it's going lower, you can sell it. You will be quoted two prices, the bid and the offer. The bid is the selling price. The offer is the buying price. That's what you'll pay. So typically, if we look at Vodafone again, I think they're about, you'd be quoted £2.10 to £2.11 or whatever they are. I think we've got an example actually coming up now. The difference between the 10 and the 11, that penny, that's the spread. Yeah, here we go. So we've got Vodafone currently trading at 2.19 at 20. So if a character here believes that Vodafone's going up, he buys £10 a point at 2.20. His friend Dick believes the shares prices are going to go down, so he sells £10 a point at 2.19. Obviously, if they go up, Dick does well, and if they go down, sorry, Tom does well. If they go down, Dick does well. If anybody wants these slides later, let us know and we can email them out to you. It's not a problem. Then we're coming on to the cost, margin and managing risk. As I was saying earlier, the cost is typically blended into the spread. Margin, then, is the amount of money you're required to put up to hold a position. As I was saying earlier, typically with Vodafone, they require a 10%. There are some spread bettors who offer you 5%. that's, again, being very dangerous. Therefore, as I was saying earlier, if you hold a £10,000 position, you'd need £1,000 to hold that. Stop loss orders can massively reduce your risk. If you place a stop loss order, there's no guarantee that they'll, because if the market was to open below your order, then you won't get taken out. You can buy a guarantee stop losses through many of the CFD providers, but they are expensive for obvious reasons. Before we go into short selling, anybody got any questions? So I've got literally about an hour's worth of content to get through in about 20 minutes, so I'm skipping through it. But anybody got any questions? No? Are you all happy? Okay. We'll get on to the main part. Is this why everyone's interested in short selling? Heads are nodding. Beers throughout the room, eh? Okay, so how many of you short sold before? So you're all quite used to short selling? Yeah? Okay, cool. Short selling is a strategy used by investors to balance portfolio allocations and manage risk. On a prop desk, we used to short sell. The prop desk I worked on was we used to use 70% long and 30% short. So at any one point, our book would be 30% short of the market, and obviously to balance and hedge our risk. Short selling, in my mind, also provides a very important role of price discovery and provides liquidity in the market. A lot of people are complaining these days there's no liquidity, especially in AIM stocks. Part of that is down to the fact that you can't short, or you can't get to borrow in stocks to actually get in there. And if, for instance, you have a stock which has got a particularly low free float and is controlled by 3 or 4 large investors, then they can get the share price or the valuation of that company a lot higher than they should be. So why would you short equities? Well, as I was just explaining, portfolio protection and manage risk. In the last few years, there's a few products come available, more and more available now to the retail guys, such as ETFs, exchange-traded funds, which I think are great if you do want to hedge your portfolio. You can also protect against volatility and drawdowns, and obviously, which most people here are probably interested in, is benefiting from the falling share price. Physical stock. So if you're going to short physical stock, this is known as being a covered bear. This is done through your prime broker, and a lot of costs apply to that. And typically what happens is the prime broker will have to go out to a fund or go through his prime broker. Typically would be Commerzbank, for example. So if I had a client phoning me up and saying, right, I want to go short of a stock, let's say it was Vodafone, I would go to Commerzbank, I would phone them up and I'd say, I'd like to borrow 100,000 shares in Commerzbank for delivery. They would lend me that stock, and I would then lend it to my client. The client would then go, well, I would go and sell the stock in the market, and we would deliver that stock against it. And obviously the cost applies to that. So do you all understand why a fund would want to lend out stock? Yes? No? No? Okay. Okay. So if you were to take Scottish Widows, for example, they may have a very large position in Vodafone. They don't care about the short-term movement of the stock. They don't care if it goes down to £1.80 or back up to £2.50. They're looking at dividends, and they're also looking at where the stock is going to be in 5 to 10 years' time. They're very long-term. So short-term movements they don't care about. However, if they can lend out their stock and charge an interest on that, typically they get 4, 5, maybe 6% interest, they're actually gaining a lot more money. So that's the reason why an institution would lend out stock, is to improve the performance of their own portfolio. Other products available then, obviously, this is focused on spread betting, so single stock derivatives on CFDs, which are contracts for difference, and spread betting. And then, obviously, other ones are put options and ETFs. So I just say, well, I've actually just gone through this, but whenever you choose a stock to short, you need to go to your prime broker and you need to borrow that stock to execute against the trade. And by execute, I mean deliver the trade for settlement. If there's no borrow available, then most brokers now will not allow you to short because you get bought in against. Cost of borrowing margin products. You have to pay an initial margin, the same as with any CFD product, on all your long and short positions. For all stocks, where the borrow is ready available, so for a stock like Vodafone, for instance, it's very, very easy to get the borrow on Vodafone. If you were to get a smaller company, maybe a 20 or 30 million pound market cap resource company, the borrow will be a lot more difficult because people aren't going to be that keen to lend you any stock. And if they do, then it'll be incredibly expensive. Again, for stocks where the borrow is less available, you'll have to pay an extra daily funding charge, or referred to as a special borrow rate. So if you were very keen to short a stock and you were convinced it was going to go a lot lower, then sometimes you can pay up to 10, even 12% interest. If it's going to go bust, then it's worth paying it. If not, that's a decision you have to make on your own, towards your own portfolio. Again, the less available the borrow, the higher the special borrow charge will be. You also have limited availability of the free float. Everyone understand what the free float is on a stock? Some nodding heads. No, you don't? Okay, so if you take an equity, for example, if there's 100,000 shares, you have to have a minimum amount, according to the stock exchange rules, of free float. So it means to be at least 25% of the shares available to trade. That's the minimum. Some companies have up to 70% available to trade. Some have, 94, I think, is the highest. But you have to have a minimum of 25%. Let's say, for instance, two guys own 12% each. That takes you 24, so there's only 1% available to trade. So therefore, it's quite difficult to trade that because it's very illiquid. And that's typically where, you get unusual moves in stocks, is where the free float is very limited. Again, as I was saying here, there's concentrated holders of the underlying stock. They may not want to lend. There may be a lot of short speculation on the underlying stock, which, again, comes to restricting the borrow and the price variance, and M&A speculation. So very, very quiet crowd. Is there any questions at all, or am I sort of... A CFD is a contract for difference, and a spread bet. Well, there's actually no difference at all, except for the way they're treated by tax. So if you're going to trade a CFD, CFDs were the initial product they launched, these companies. It's quite important, actually, if you're going to trade spread bets or CFDs, that you understand what the product... I obviously came from the stockbroking background, and the spread bet is made, when they first started, made a big fuss about the fact there was no commissions, and we don't charge where your stockbroker charges. The thing is that they blend their commission in, so there isn't a charge. But it's quite important to realise that it's a very different product. Stockbrokers make their money out of charging you commission. Spread bettors and CFD providers make money out of the funding product. They don't care about the commission is a byproduct. All their money and all their business model is to lend you money to buy stock and charge you interest on that. They're a mortgage company, for want of a better word. Instead of buying houses, you're buying stock from them. So that is how it works. So a lot of people get focused on the commission. They think, I'm paying very low commission rate. I'm only paying 10 bips or 20 bips. But what's important is the fact of how much finance and funding they're charging you. That's the important bit. So you could find they're charging you... I've had clients who've been charged 3-4% on funding, which is, very expensive. Typically, I think for somebody opening an account, it typically should be around 2.5%. And depending on how much money you've got with them, you can usually negotiate down to sort of 1%. The funding rate then would be 1% plus or minus LIBOR. So if you're long, it's plus. If you're short, then it's minus LIBOR. And then you get, sorry, we're just talking about this. The amount of LIBOR is the CG rate. CG is the general collateral. Yeah, general collateral. I couldn't remember then. General collateral rate, which is effectively the margin. This is just another term for margin. And CG rate higher than LIBOR is the difference that is charged. Sorry, did I answer your question on CFDs? Yeah, cool. So the application of special borrow charges, the special borrow charge is quoted as a rate over LIBOR and applied daily to the value of the short position. It's probably highly unlikely, unless you're quite sophisticated investors, that you'll ever discuss this with your representative at the spread betting company. They'll probably not want to talk to you about LIBOR or anything like that, or the rates, but they do apply. Special borrow charges, as we were covering earlier, can vary over the life of the short position. So as LIBOR changes, so can the costs of your borrow, either you're long or short. Okay, so which borrow costs are likely to apply to a CFD position? So you've got your general collateral funding rate, or again your margin rate. It's paid by the broker, normally marked up to clients. So if I've got a client and I've got to pay 4.5%, I'll normally mark it up maybe 0.25% or whatever I can get away with to that client at the other end. And that's typical, that's industry standard. And we have to borrow through obviously the wholesale market. And the CFD brokers generally pass on special borrow rates to the clients. Here's another example, which I don't think there's much point me going through that at the moment. You can go through this later. A borrow call. So if you are short at any point, so I've borrowed my 100,000 shares off Scottish Widows, and they can phone me up at any point they want, and they say, we want that stock back. And they can call it now T1, so I have to go back in the market immediately. I either go and borrow it from somebody else and deliver that to them, or I go in the market and buy the stock back. And this is where it can be very dangerous, is if you are short a position, the stock becomes illiquid and they call you in on it. Then you may have to pay, and if you don't buy it back in, the CFD or the spread betting provider or the broker has to go into the market and close you out. And that can be a very, very expensive situation for all. At that point, is there any questions? No? Okay. If you are short, obviously you have a dividend liability. So if a stock pays a dividend and you're short, then you're liable for that dividend. You have to pay it. So again, don't be short over the ex-date of the stock, because if they're paying 10p divvy, then you have to pay 10p for every share you're short. If you're trading AIM stocks, it's highly unlikely they'll be paying a divvy anyway, so don't worry about it, but it's something to be aware of. So prominent promoters of shorting and bears, company in America, well, both the top ones, top two, they're American, Muddy Waters and Gotham City, which I'm sure many of you heard of. And there's also Iceberg Research, who do they're more specialist fund that look for special situations and identify them. Iceberg tend to be more focused towards the hedge fund guys. So it's, at the moment, it's quite unlikely that would be in the public domain so much. Regulation. So shorting without first arranging the borrow is known as naked shorting. I'm a big fan of shorting stocks because I do genuinely believe it's the way the market should act. But the SEC has banned it, and there's restrictions now in the UK with since 2008, where everyone blamed everything on people going short. My viewpoint of it is that for there to be, you need to have a difference of opinion to create a market. Okay, two people need to disagree on something. If you've got a situation where one of those people can't actually do anything about their view, if I think something's overrated or overpriced and I can't actually go short of it, then it's not a real market, as far as I'm concerned. And that's the situation we find ourselves in now, where we're over-regulated. Shorting stocks is not the done thing, and yeah, it's not a true market as far as I'm concerned. In many countries as well, it's the exchange that penalises people for going short. When I first started in the industry, there was no CFDs or spread betting, but you did have, you could trade on extended settlement. And it was quite a regular thing for people to trade T25, which meant you had 25 working days to settle a stock, and you could go long and short, do whatever you want, and they were more accurate markets, I believe. And there we are. Any questions? Which so far there haven't been any, so I think this is going to be the shortest part of it all, I think. Anybody at all? Yes? Sorry. Yeah, sorry, gentleman here was asking, do you still have to pay tax if it's your only source of income? That's a good question for your accountant. I am aware of some people who are using spread betting as their only income, and the revenue will look at that and say, hang on, this is your income, and they will charge you for it. So you have to be a little bit cute. So typically, no, but if it's your profession, if it's your only income, then they will. So I recommend you find another source to offset against.
And then making money. Because a lot of them make money from shorting that stock.
So the gentleman here was asking, what are the mechanics to getting into a highly profitable situation? That's the beauty. If I knew that, I wouldn't be standing here. Yeah, I mean, look, that's a bit of an open-ended question, but I mean, yeah, I mean, I suppose again, if you can get the borrow on the stock and you think something is overpriced, and typically, you know, a lot of people, especially new people who come into the market, inexperienced investors, they tend to fixate on the share price. So they think, oh, something's a penny share, it's cheap. You really need to look at the market capitalization of that company to decide. So, you know, you could have a company that's a penny share, but it could be £500 million market cap on it, you know. That's why you need to focus on, not the price, the share price. That's in my mind anyway. Anybody else? Yes. Okay. So the gentleman's asking of the three I suggested, which is the easiest. By far the easiest for you guys is to using a CFD or a spread betting provider, definitely. Because they'll take all the legwork out of it, they'll go and get the borrow. And also, the beauty about spread betting is that, or for the spread betting for providers, and this is where they make a lot of money, is if I've bought 100,000 shares in Vodafone today, and you come along tomorrow and you say, right, I want to sell 100,000 shares, they'll actually hedge against us too. Okay, so the spread betting provider will actually have a zero position. You're short 100,000, I'm long 100,000. They'll be charging me funding, I'm charging you funding, and they're making all the money for having no position. So it's a brilliant model, to be fair to spread bettors. No, it's not. No, it's to be fair, it's quite reasonable. But I mean, it's like anything. It's you know, it depends very much on the liquidity, free float. Like I say, if you're going to short Vodafone, it's very, very cheap. If you wanted, I'm not sure what the borrow rates were on Quindel, but as the story was escalating, more and more people were going short, then, you know, getting the borrow would have been more and more expensive. So if you had have been in the early days, you could have probably borrowed it very inexpensively. But then as the story escalated, then it probably would have got more and more expensive. And typically, you know, if you've got a special borrow rate of sort of 1%, 2%, 3%, and all of a sudden the borrow rate goes up, you either have to close out the position. They might even close you out, so you re-borrow to adjust the borrow rates and things like that. But yeah, if you're going to short large cap stocks, it's very easy. Indices and FX, again, it's very, very easy because they're not actually buying the underlying in that stake. They'll take you on their own book. You know, they're a betting company. They're a bookie at the end of the day. You know. Yes, sir. Okay, gentleman there's asking, do you do it over a single day? or over a period. It's totally up to you. You can do it for as long as you want. I think I said earlier, it's not really suitable for long-term investments. So if you're buying something and you think, right, buy this for 3 years, then the amount of funding you're going to be paying and things like that is going to be cost prohibitive. You do on different spread betting providers work different ways. So you can have, for example, with I don't want to mention any names. So one spread betting provider I know quite well, certainly they have an annual rolling situation where if you bought Vodafone on the 1st of January, they wouldn't close it out until the following year. So they close it out and open it up again. Some spread betting providers have a daily rolling. So every day they would close you out at the close price and open you again straight away in the morning price. The advantages of that is that you actually realise the funding every day. So you can keep track on where things are. But, I mean, yeah, the duration is totally up to you. You can keep it for anything up to sort of 2 to 3 months if you wish. Yeah, on every day. Sorry, what's it? Another question. You say that the owner of the stock wants to write back any time. Surely they want to understand the spread betting companies. Right, okay. So the gentleman's asking the owners of the stock, whoever's long the stock, can ask for it back at any one point. It all depends on who you've borrowed the stock from. So, as I was saying, if you understand the business model of a spread better, they are a bookie. Okay, so he can sit there, and there's enough volume between them. They don't actually have to go out and buy the underlying. So, if you were to short Vodafone and I'm long it, the spread better is standing between us. So that's that. If you actually physically have to go out and borrow the stock, then that could be called in on you. And again, I mean, the spread bet is effectively a bookie. So with a large cap company, it's very low risk. But if you were going to deal in something highly volatile, as this gentleman said earlier about Quindel, that was a highly volatile situation. So the risk department of the spread betting company may have looked at that and thought, okay, we don't fancy being naked to this, or having the risk, especially if most people are short. So they might have to go into the market and borrow that stock in that situation and then lend it out. And if that gets called in, then you can be bought in at any point. A friend of mine who's actually a market maker was telling me last week he was bought in on a stock last week, £50 worth of stock on an AIM share, which is ridiculous. It's like unheard of, but that's the way we are now. Anybody else? We're on a roll, come on. Okay, is that it? Okay, well, I'm over on the standby there for Vox Markets there, and you got any questions and you want to come over and ask me, please feel free at any point. And thank you very much for listening. Thanks.